Hit it.
It's Friday, December 15th, 2023, episode 228. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show Edward Harrison, author of the Everything Risk letter on Bloomberg News. We have a great discussion about the risks he sees developing in the markets, how he thinks it'll play out, and finally, we learn that he has to be the most accomplished market huddle linguist we've ever had the pleasure to interview. We're almost through the year, and lucky for us, that means we only have 2 more talking charts with Patrick left. Strap in and grab a drink to find out what Patrick thinks about the markets this week.
And then we end with Crayons with Kev. I'm looking forward to that one, Kev. And then No Stupid Question, folks. We might even drink some beers along the way. So, Lena, hop on. What beer am I drinking this week?
So this week, Patrick is drinking Mean Sardine Brewery's Ericeira Sunset Blonde Ale.
Ooh, you know, that is a beautiful place in Portugal to watch the sunset. But what a great name for a brewery, eh? Like the Mean Sardine.
Yeah, the right choice for any moment of your life. Light, refreshing, and easy to drink. The best aspect of Portuguese summer, even on rainy days.
Yeah, it's
is that what it feels like when you take a sip?
It's incredibly light, though. Actually, I like beers with more punch. It drinks very smooth.
So, Patrick, I want you to bring home one of those for me.
All right, done deal.
That sounds like my kind of like mopey beer.
All right. Kev, give us some side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the Delta Dingleberries, Krayon poisoning with Pat, and the spreaded Eagles.
Oh, there you go. Let's get Ed on the line.
It's our great pleasure to welcome back to the show Edward Harrison. Edward is the author of the Everything Risk newsletter for Bloomberg News. Ed, thanks for coming back.
Good to talk to you, Kev.
We were just kind of shooting the shit and laughing that saying the last time that we got together for you to be on the show was right before COVID.
Yeah, I know. I mean, that is amazing. First of all, how long it's been.
Yeah.
You know, that's like almost 4 years now, but also just all the things that have happened in the interim.
You're absolutely right. So Ed was kind enough to come to Toronto and we taped it live. And so we were doing it face to face with beers. And then we all went out, me, you, and Patrick afterwards. And it was probably one of those nights that nobody can remember very much. But anyways, listen, lots going on in the markets. Let's talk about markets instead of drinking stories. I guess we'll just start with Wednesday. The Fed, everyone was expecting, or I shouldn't say everyone, most people were expecting the Fed to push back on the easing of financial conditions, and they did nothing of the sorts. And in fact, they might have even encouraged the market to price in some extra cuts. What do you take from that?
Yeah, I mean, it was pretty surprising. In my Everything Risk newsletter, I talked about what my expectations were. I thought that they would go from 50 in 2024 to maybe 25 bips, even who knows, even stand pat at a minimum. And so if you think about what Powell does and what the FOMC does, you have Powell and you have the FOMC separately in terms of, are they hawkish, are they dovish? And in both cases, we got, as dovish as you could possibly imagine, given the circumstances, i.e., they went in the wrong direction from what I thought, and on the dot plot. And then Powell basically gave no pushback. He was asked, I think, by Steve Leisman and by Nick Timiraos, do you push back? And he basically said, you know what, I'm done with that. They'll meet me somewhere down the line. We just have to do what we need to do.
Right. It was amazing because Nick did for sure set up the softball for him to hit, and he just said, nope, not even going to swing at it.
I was shocked at when he was like, they'll just meet us down the way. He just completely, I mean, you could understand why he might say that just from an academic perspective. He's sick and tired of the back and forth, the whipsaw in markets based upon any guidance that they give to try to talk the markets down, and he's just going to do what he wants to do. But ultimately, there's a recursive nature there. That is that what he says matters, and it has an impact on the economy as well as markets over the interim.
Right. Well, I guess by him going more dovish and allowing the market to price in more cuts actually reduces the chances of those cuts occurring because the economy might do better. Is that what
Right.
you mean by a recursive nature?
Yeah, exactly. It's like, fourth dimensional chess. And I think maybe John Authors, who's at Bloomberg, he got at this in one of his newsletters. And I think he said, if this is the game that Powell's playing, it's a very dangerous game to play because, it can get out of control very quickly. And it certainly has been quite powerful.
Now, meaning get out of control very quickly in that the market takes it too far? And if so, is that why we saw John Williams appear on that other station this morning, basically pushing back a little bit, I would say?
Yeah, I think you can go too far in two ways. One, you could have sort of irrational exuberance in a way that makes it harder for them and makes it so that they actually have to stay higher for longer, and that could down the line, or would down the line, I would imagine, lead to a recession. And then the second is that the market, you're setting the market up for a huge fall when the data disappoint, and then suddenly they have to reverse course. I mean, it was interesting. Williams came out and he said, wait a minute, we weren't really, I know that Jay Powell made it seem like we were talking about when we're going to start cutting. We didn't really talk about cutting at all. We're not cutting. And then Raphael Bostic, who's probably one of the more dovish members, the Atlanta Fed president of the FOMC, he said, Q3 2024 will be the first time that they will cut, according to him. And
when did he say that this afternoon? I must have missed
this afternoon.
Oh, okay. So he pushed back as well.
Right. Yeah. So I mean, he's relatively dovish, and he said, I only penciled in like two rate cuts in 2024. And I said Q3. And everyone knows he's the one who's been out front pushing for the pause for a long time. So to me, what he says matters in terms of, this is about as dovish as it's going to get. The market is way out over its skis with March. It's never going to happen unless the data, completely collapse.
I got it. Now, do you actually think that they're doing more harm than good with their SEP, the Summary of Economic Projections?
I'm starting to lean in that direction at this point because ultimately there's a certain incoherence to it. When you look at this particular one, I think the incoherence comes from the fact that apparently the median versus the mean was slightly different, meaning that there were more people who were hawkish than were non-hawkish in terms of the actual dots. But the way that it worked out in terms of the mean, it came out that the number was 62.5 cuts versus 50 last time. So basically, we're splitting hairs here, and you can't tell a consistent message based upon the aggregation of all of the members together.
Yeah, and not only that, if you're having all these FOMC, I guess, are they governors and presidents, if I got it right, that are sitting on the FOMC board, they're all talking what they think. It confuses the market. And I always try to tell people, no, there's really only three people you listen to. You listen to Powell, Jefferson, who's the Fed vice chair, and Williams, because he's running the Fed, district that really matters, New York. Do you agree? Yeah. Do you agree with that those three, all pigs are equal, but some pigs are more equal than others?
I would say that in the end, those are the three that you want to listen to. However, I would say that there are what I would call zeitgeist type individuals who are pushing the envelope, the path of least resistance, or, where the Fed is headed. When the Fed was behind the curve and then they started to push up rates, it was Bullard. Bullard basically, every time that Bullard said something, he was like, you know what, maybe we should go like 0.5%. I'm just floating that. I'm not that I'm definitely saying that this is going to happen or I'm behind that, but, it's something that we should put on the table. And then lo and behold, not only did they do 50, but then they did 75, and they did it multiple times in a row.
So is your argument that they, by putting it out there, they're trying to influence other committee members?
Yeah, I think that they're basically giving you the range of outcomes. So in the recent times, I think the range of outcomes ever since Bullard left are between what I would say are Bostic and Bowman. So Bowman's telling you actually, I want to hike. And in fact, my dot says so. And Bosick was telling you, I want to pause. And, my dot says so. And that gives you the range, and no one's outside of that range. And so that gives you a better sense of, what kind of range are we talking about? But you don't know what the central tendency is, which is what we get with the dot plot. And that's why the dot plot's difficult, because I think the range is almost better than the median, than the dot plot.
Got it. One of the things, like, you're sitting here and discussing, and you're understanding the nuances of the different members and the different realistic outcomes. But one of the things I always find fascinating is that other stir traders, like short-term interest rates or other bond traders, they understand this. But then you talk to just a general portfolio manager or equity folks, and they're all over the map. And like, I used to hear stuff and I'd be like, you guys just don't understand. The Fed doesn't surprise like this. Like, they would talk a week before the Fed's going to go 75 when 50 is clearly priced in. And I get it. Sometimes they did change it at the last not at the last moment. They guided it at the last moment. But realistically, we all kind of understand how this game is played, but it doesn't seem like the other members of the financial community understand it. And that's why I think that a lot of this talk actually is detrimental, because there's all sorts of kind of wild theories out there. Do you notice that same thing?
Yeah, I think that the further you get away from those markets, those stir markets that you're talking about, the more you get sort of like conspiracy theories of what's going on. I think the biggest conspiracy theory now, to be honest with you, is that Powell, he's ready. He's taking sides in the political spectrum. He's like doing what he's doing in order to ensure the soft landing, and that's because he's a partisan. That's something that you would hear for sure.
And let's go down there. I was going to ask you about that, whether he's feeling any of the pain, the pressure about that. And would you not agree that absent Trump, he would be more comfortable being more hawkish?
What I would say is that he was asked point blank, what do you think about the election next year? And I can't remember who it was who asked him in the press conference, and he gave the boilerplate answer. But he said it with conviction, as if he actually really believed this. That we're going to do what we're going to do.
But doesn't he have to do that, Ed?
Right. It's almost the same thing that he said with regard to I don't care about financial conditions. But with this, he has to do that. He has to say, it's like when he says that, I don't speak about, fiscal policy. But the reality is, we all know, the reality is that the Fed does not want to be engaged in active, market moving actions right when the election's about to come. That's just the reality.
Oh, I agree with you there. But then couldn't you make the case that would be therefore encouraging him, if he is going to switch, that he switches sooner rather than later?
Right. Yeah. So I think that is the thinking. And, I think that there's a basis to that. But you can also take that further and then say that he's in the tank for the Dems or something.
Oh, no, he's not going to do that. We're talking at the margin. I think we can all agree that this is at the margin. He's not going to go and lower rates 100 basis points to make sure that the economy is flying. Like, let's face it, we can't extrapolate, but we can say at the margin, he's looking at this and saying, I don't want to be the one pushing our economy into a recession. And we all know that no sitting president has won when the economy is in a recession, right?
Right. And by the way, let me just say that, just imagine that Trump locks up the nomination very quickly. At some point, and even before he does that, he's going to pivot to Jay Powell. Right.
After all, he can't putt.
And so he's going, that's going to apply some pressure on Powell, because suddenly, he'll be part of the political, the political dialogue.
Yeah, you're absolutely right. And that is the one thing that Jay does not want to be. He doesn't want to be seen as being overly dovish to help, Biden win.
So,
which could become part of the narrative, right? Trump might figure that out and actually start saying that.
Right, exactly. So I think that this is where we are. There are a lot of considerations to make, and I think that the market's gotten way out over its skis with regard to rate cuts at the beginning of 2024, and we'll just have to see what the data say, and then what the Fed members say as we go. The real question I have is when the cuts start, when we start getting to the dates where people are talking about the cuts, what's going to drive the narrative between now and then? So the first cuts that people are thinking about for real are March. So we have 3 months before that happens. What I would say is what's probably going to happen between now and then is that we're going to see some bear steepening. That is, the back end of the curve is going to go up. We're going to start to price out the cuts. And, the 2 years is going to go up, but the 10 years is going to go up more. And we're going to start to see, the curve uninvert the closer we get to those levels. And the reason being that the economy is doing well enough and inflation is high enough that they're going to start to doubt enough. And the Fed speakers will say enough that these cuts that are priced in are excessive.
Okay. And I think we can all agree that the market probably priced in too much too early. But one of the things that I find fascinating about this cycle that might be significantly different than other cycles is that we could have a situation where inflation is coming down hard in a period when unemployment isn't going up.
Mm-hmm.
And so part of the argument about why, like, if you go look at like a forward 1 year rate and you compare that to inflation, you'll see that although the inflation forward, the 1 year ahead inflation swap, you'll see that it's come down from 260 down to 2. And really, that's in essence what's happened is we've priced in an extra 50 basis points or 60 or 75 basis points of cuts in that period. So some of the argument is that this is just them keeping policy at the same real level. So do you think we could have a situation where the economy is doing fine, it's still strong, unemployment doesn't move, let's just imagine it stays here solid, okay, and yet inflation comes down enough in the coming 3-6 months that they actually do lower rates even though there's no uptick in unemployment?
I think that inflation can come down enough that they lower rates, but it wouldn't come down enough that lowering would be a positive outcome, because I don't believe that inflation can get to levels that would be commensurate with a non-accelerating inflation at these levels of unemployment. And so by that, what I mean is let's say we get the soft landing. We're at 3.5% PCE inflation. We're at 4% our core PCE, 4% core on consumer price index. And, by March, let's just say that we're at like 3%, 2.9% on both. So 2.9% down from 4 on CPI, and we're down to 2.9 from 3.5. That's solid progress. We have a 2 handle. We're within striking distance, and the Fed says, okay, let's pull the trigger. Let's cut. The problem with that is that unemployment is now 3.7%. Let's just say that it's 4% at that time. 4% unemployment and almost 3% inflation. Is that a starting point for a massive bull cycle that's going to take you 10 years without pain? No, it's not. What it means is that you're in a situation in which the economy, you're running it hot, and the potential for the Fed to come back for unfinished business because inflation starts to percolate up from that level is much higher.
So do you think that the 1 year inflation swap, which was like 2% a week ago, and is now 2.15, is wrong?
Yeah, I think that's too aggressive. 2.6 is much more in line. And when you look at all of when you slice and dice the numbers, basically what you come out with is that the pandemic has gone away. that, when they talked about transitory was transitory, but it took longer to happen. And so what we're seeing now is goods inflation going away, and now it's deflation. We're seeing a reversion to levels on oil that are oil prices that are commensurate with lower inflation. And so now we're at a baseline level. But now that we're at that baseline, we have two things that are working against us. One is the potential for those numbers to tick up again. That is the disinflation and the deflation in those levels. And then two, we also have the core, especially core services, which is still running above 3%. So there's no way, unless you can get that core and that core services down into the twos, that you're going to get a 2% number in a year's time.
So now, I'm sure Jay Powell's heard the old saying, and he actually encouraged it and said, "I'm not Arthur Burns. I'm Paul Volcker." And yet, I'm sure Arthur Burns thought he was doing the right thing for the economy as well, and yet we still had the second wave of inflation. Do you think it's just possible that Jay's going to get it wrong as well, and that we're going to repeat the mistake that was made back then?
Yeah, I mean, to be honest, that's been that's what I've been thinking would happen. Like if you think about Arthur Burns, did he have a mandate to pull a Volcker in 1976? 1974 was a horrific recession. And by the time that we got down to, through the recession, we still had 4.9% inflation at the end of 1976. At that point in time, did Arthur Burns have the mandate to be able to crush inflation? I think the answer is probably no. And so equally, does Jay Powell have the Volcker? I mean, if he pulled a real Volcker at this point in time and jacked rates up to 7% because inflation was 3.5%, wouldn't there be a massive backlash? Yes.
Oh, yeah. Yeah. People think that Paul Volcker, like we, on Wall Street, celebrate him, but he was a bum for most of people on Main Street.
And even after 10 years of pain, he wasn't good in 79, 80. He had to come back at it again. He still was considered a bum. So even he had a very difficult time in the moment dealing with the situation that he had. And so it's hard to think that at this particular juncture that, Jay Powell has the mandate to be Volckerian.
I like that. One of the problems, though, about being Volckerian is that the reality is that the monetary policy doesn't mean as much as it used to, in that a lot of the credit creation is not being done from the private sector side, which would be affected by higher rates, but by the government side. Like they go and Jay Powell raised rates, but it didn't seem to slow down the spending of Biden and company. I'm just wondering whether you think that there's a chance that Powell has realized that his kind of his arsenal, his tools aren't as powerful as he thinks.
Well, I think that there are two things on that. One, there used to be this monetary offset, right, where if you had looser policy, then the monetary policy could be tighter. But then there's also the concept that we had zero rates for 15 years. Okay. And then we went to the rock bottom with a curve that, flattened out incredibly after that 15 years, just as it had in Japan. And America, with its 30-year mortgage rate, basically everyone refinanced. And so for me, the real problem is the fact that it doesn't have the bite because there's no one to bite when you raise rates. Let me give you an example. So let's say that there's like 10 to 15% of the people who want a mortgage who will be affected by rates going up. Of the other 85%, a very large percentage, perhaps a majority, either want you to jack rates up because they have savings,
Yeah.
or they have no mortgage whatsoever, and they again, don't care. They're ambivalent about the whole thing. Once you've locked in the 30-year mortgage, you actually want rates to go up. You don't want them to go down, because then you're able to, basically pay for your mortgage through the savings that J Powell's giving you by raising rates. So that very narrow segment of people is bearing the entire pain that's supposed to be slowing down the economy.
Right. And the other thing to think about is that when it comes to companies, we're talking about, people are talking about the refinance wall that's coming in 2024, 2025. But a lot of that refinance wall is actually smaller companies, because the longer companies, the Apples, the Googles of the world, they extended duration, as you pointed out, when the curve was so flat. And they've actually benefited from Jay Powell's interest rate hikes, because they've borrowed long and then they've earned money in the short run. So they're actually winning on both sides. And so one of the things that I kind of wonder about with Jay in terms of his policy is that, yeah, he can be all tough talk all he wants, but the reality is that he's not affecting the economy like he wants to. So why bother being so tough?
That's the problem, and so I think that we got to a point, especially on consumers, where 8% mortgages, it was too much,
Right?
And so I think to a person, they welcomed a certain amount of easing of financial conditions, but at this point now, it's been so excessive that you do wonder whether or not it will give more oomph to the economy in a way that's deleterious to their ability to fight inflation.
Fair enough. So when it was at 5%, it was obvious it was gone too far. But now your argument is that it's with this amount of easing, it's gone too far the other way so quickly.
Exactly.
I got it. One of the things that you mentioned Japan, I was wondering what you think about Japan and their attempts to get off of negative NERP, negative interest rate policy, and whether they're going to be able to do this without a financial accident.
Yeah, that's a great question. I think that it is the $64,000 question. And my sense has been for some time, as many others have speculated, that they will take this opportunity. The answer that I come up with is, if not now, then when?
That's a good one. I like that. Yeah.
It's the same thing with regard to when Jay Powell tried to raise rates in 2019, and then again when we raised them finally with inflation. How much inflation do they need to have? How good does the economy need to be for them to do it? So if they don't do it now, when are they going to do it? So I think that it's a matter of time, and the real question is how good is the economy? If the economy holds, then I think they will do it.
Well, I don't worry about the economy as much as I worry about the financial system. I
Right.
kind of feel like that this yen carry trade is one of the biggest trades out there, and I just worry about a huge unwind. And I'm hopeful that their baby steps that they're taking is them trying to shoot to missiles over the bow of the ship, trying to tell everyone to get off, and that hopefully they've taken that into account. But a little part of me just worries that there's always a crisis that few see coming. Like it's never the crisis that you think it's going to be. It's always something else. And to me, this has the makings of a potential problem.
Well, without a doubt. The only problem is that you won't know the problem exists until they actually do the policy. So I don't believe that the financial accident will occur until after they've started to raise rates. And so they'll have to find the all clear economically, raise rates, and only at that point are we going to find out whether or not they created a problem.
Fair enough. Oh, I get it. And do you have any ability or any ideas about the discounting of that potential unwind?
I don't at this point because in my mind I think the paradigm that I have is it's a massive scale of the Swiss franc. The Swiss franc when they were holding a peg against the euro.
Yep.
When that peg it went hard, like 20%. And just imagine if something like that happened. And, there are all these people who are playing the low vol game, selling vol, currency vol over in Asia, not just to get with the yen, but other currencies that are associated. So you have like the potential for, people to get run over in numerous ways and in numerous places, not only in Japan, but in other currencies that would have knock-on effects from anything like that.
So you brought up vol, and I guess you're talking about structured products of some sort, and
right.
And it's not just in stock market. There's people selling vol in the currencies market as well.
Yeah, so I mean, Mrs. Wanatabe is, she needs to get some extra juice, and there are ways. There's some volatility action, and all of the Asian central banks have been suppressing volatility, and if you get a end of negative interest rates, suddenly you could get a massive amount of volatility all at once, and those people who have been on the wrong side of that selling vol will get hurt as a result of that.
And speaking of volatility, we have a situation where the VIX is back down to, I don't know, what is it, 12 or something like that? Do you have any comments about that? Do you think that that's a function of the zero DTEs, or do you think that, I guess in reality, we're kind of realizing sub 10, so it's not like it's, it's mispriced versus what we're realizing, but are we setting up ourselves for a big shift if, for example, the Fed kind of has to take rates take expectations and put them back higher?
Well, I think you're shifting from Japan vol and Asian central banks suppressing volatility there to the VIX is a good one because it shows you, regimes that are built on low volatility as a unalloyed success and positive are fragile by nature. Because once the volatility spikes up, then you have all sorts of unexplained and unforeseen outcomes. Because people who didn't know that they were taking vol bets, essentially taking bets on vol, will suddenly realize that they were. For example, what's the volatility of some of the Magnificent Seven? Is that what's going to happen to them in a new regime when the VIX goes up? Things of that nature. Tesla is a perfect example. They're in the Magnificent Seven. I look at Tesla, I look at NVIDIA as companies in particular that are the most vulnerable of those seven. And I think that in a regime in which volatility goes up, and mostly volatility will go up when we see air pockets on the downside, then you're going to see some people get run over in a big way.
One of the things that might kind of trigger that is the fact that we have crowding like we've never experienced before. And I think if I told most people in January of this year of 2023 that rates were going to go from whatever they went, like, were they 2% at that time to 5%, and asked them what they would have invested in, very few of them would have said the Magnificent Seven. And yet, it just shows you how hard this game is. Yet here we are. And one of the things that I always hear now is that the Magnificent Seven is bulletproof. And right. you had that Goldman Sachs graph the other day that showed the actual crowding of hedge funds within the Magnificent Seven. And it worries me that everyone is just so convinced that this is the one trade that's going to work, because it has worked and they're all long that and they're all short everything else. One of the things I worry about is kind of almost a mini quant crisis. We had, what was it, 07? We had one of these where you have like the ability for the market to have violent moves within it is much higher than most people expect. Would you agree with that?
100%. I mean, like, let's go back to 99 and what happened there. Like, a lot of people talk about, Cisco or, pets.com or whatever, but really what they should be thinking about are the massive size of the companies that dominated the index, including GE for that matter. Right. So you have companies like GE, you have Cisco, you have Microsoft. They're dominating the index. If you want to index, if you want to outperform and you're not in these companies, you are going to get run over. You're going to lose your job because you were underinvested in those particular companies. This is exactly what's happening now. So what people are finding is that they have to own these companies, because if they don't, then they'll lose money compared to their indexes, and so that creates a problem, especially for the ones that are the most vulnerable within the seven. They're not all created equal. When the proverbial hits the fan, so some of them are going to fall.
And you can say shit on the show.
Oh yeah, some of the Magnificent Seven are going to fall by the wayside, and much more. And we've seen that. We saw that with Tesla and Nvidia before, but now in 2023, as we've seen the comeback, they've come back. We saw that with Facebook as well.
Yeah,
a Meta, if you will.
Can I tell you a quick story about Canada? And in 1999. Nortel took off, and Bell owned a huge chunk of Nortel. So it was, in essence, trading just like Nortel. And I think that those two stocks represented 45% of the TSC 300. So one of the problems was that if you're a fiduciary that's taking, managing money, that's actually irresponsible to have 45% of your portfolio in two stocks, which is in essence one stock. And so a lot of these managers were forced to, have a 10% weighting or whatever. And so everyone underperformed.
Right.
And it was just it structurally was a terrible, a time. And what's funny about that, Ed, the TSX finally came out with a capped index. They said, okay, no stock can have more than 10% or whatever the number was. And that was like the top in the, in the index to the day. So if we ever see a situation where we get an S&P capped index, that's going to be, to fix the Mag 7, you should be leaning on it with both hands.
That's a good story.
Now, what else do you see in terms of the stock market that kind of worries you or kind of, perks your, like, I don't know what to say, like, would actually concern you going forward here? Because you are worried about the market, about the economy, and you are worried about rates. And where do you think, we're going to experience the most pain going forward?
Yeah. So, I mean, the paradigm I'm working with is that the economy reaches a level, in inflation and unemployment that is unsustainable over the longer term. And if you have money that and fiscal policy that's just tight enough, you might be able to oscillate around levels slightly above that. But when you're at like 3%, 4% inflation, and 4% unemployment, you're at the tail end of what's sustainable, and anything more, and you're off to the races. And so what that means is that we're right in that zone, which says that any more boost to the engines will send us off to the races in a sort of 1999-ish way. And as we all know, when you have those massive upticks, then you come crashing down. So that's the paradigm that I'm working with. And what concerns me, therefore, is, especially with people piled in to all of the same trade, is that when the bottom falls out, it could be very aggressive, and as a result, a lot of people get hurt, and so we have a much deeper recession than we otherwise would have.
So are you? You're saying that the financial volatility that we might experience might actually cause more economic volatility than we need.
Yes, I think that when we see stocks going up and we see yields going down, interestingly, we're seeing volatility go down because it's all going in that one direction. So when that direction flips and reverses, it could do so very violently because everyone is on one side of the boat and now they're moving to the other side of the boat. And then the feedback onto the real economy will be very pernicious. And as a result of that, we have a much deeper recession that feeds back onto the market, et cetera, until, Powell and Co. Step in and are forced to cut rates.
So one of the things that I mentioned earlier was the fact that the Mag 7 rose in a period of rising interest rates. And I think the only thing that probably surprised market participants more over this past couple of years is the fact that stocks and bonds have completely lost their negative correlation and gone positively correlated. First of all, why do you think that happened? And do you think that that will continue? And if so, what risk does that play for portfolios going forward?
Yeah, that's a good question. I think that we're at the tail end of the cycle. And so at the tail end of the cycle, you're looking for, the last little juice to be had. And so that flips the correlations. And so I would imagine that the correlations would move back the other way.
Okay.
Once.
So you don't think we've experienced a secular change in the stock bond correlation?
I don't, unless we have, unless we have a super cycle that is towards rates higher for a longer period of time. Because, the reason that stocks and bonds were moving in the same direction is because we had a super cycle in rates. So I'm thinking of rates leading and then, bonds basically benefiting from that. When you come from 14% interest rates down to zero, then that's massive. That's a massive tailwind to financial assets. It's a massive tailwind to the economy. It's a massive tailwind to leveraging up. And so you should expect a positive correlation between stocks and bonds. But what gets us from 5% to 14% over any longer stretch of time? I don't think that that's going to happen.
Okay, what about the equity risk premium? Howard Marks recently had a great post where he talked about the fact that a lot of people that are invested in the stock market should be looking at corporate bonds. Now, since then, corporate bonds have ripped higher, so it's not quite as obvious of a change. But if we look at kind of what we're paying for the stocks in terms of earnings yield versus what we're paying for what we can earn in the corporate bond market, that spread is kind of as attractive as we've seen for corporate bonds in a long, long time. I was just wondering, do you think that 2024 is going to see more finance committees kind of have a look at this and say, hey, you know what, with all this risk to the stock market, maybe we should be putting some money into the bond market?
Well, I think Marx might have been talking a little bit about junk, if I recall.
Yeah, but I would argue that it's, regardless, I think that you could say that the spread between earnings yield and the actual bond yield has narrowed in general.
Yes, and I would say that the spreads now are so narrow that it becomes somewhat problematic to get in at these levels. If spreads were to widen, and you look at triple Bs or a single A paper, really the yield pickup that you get at wider spreads would be attractive. And then just from a pure clipping coupon perspective, you're looking good. I mean, just think 4%, you're clipping coupons at 4% for a 30 or a 10-year treasury. let's say that you get a single A or triple B rated a bond at something like 6% down the line, like in 2024. Is that not compelling at 6%?
But would you say it is? And is it going to take money out of the stock market into the corporate bond market?
I would say it is compelling, but unfortunately, I don't think it's going to happen.
Oh, you're just because the spreads are too narrow.
Well, the spreads are too narrow, and the way that you get them to become less narrow is because of a recession, which means that the absolute yield will be going down as the spread goes up. Would you be able to lock in? These are like relatively low default risk things that we're talking about. Like, I mean, triple B is slightly more default risk, but really these are all investment grade. But if you can get an investment grade at 6%, then you can do that for 10 years, you're sitting pretty.
Now, one of the problems with the kind of fixed income, it seems that everyone's decided to go into private credit. Do you have any thoughts of that, or is that your public markets only kind of guy?
I'm mostly a public markets kind of guy, but I, at the margins, I'll say that I think that that's a very opaque market. And if you're looking, and I have been looking for black swan risk, that would be another place, because we were talking about vol risk. We were talking about people are always looking for what happened last time and trying to shore that up. I would imagine that private markets are a place there's hidden risk that we're not appreciating at this juncture.
Oh, I completely agree. I think but what's shocking to me is that it just continues, and none of the people investing in it seem to be worried about the fact that there's no pricing that's like realistic, that they're able to get out. Like the B REIT still got a line to get out, yet people are going into B REIT 2 or whatever it is.
Well, let me give you an example, an analogy, from the Milken days. So Milken, when he got into high yield, he ran the numbers. He was like a math geek, and he looked and he saw that the risk reward for these companies was very skewed towards reward, because people didn't want to touch them, and so the spread was massive, and so therefore this was an underappreciated market, and you could get massive returns for not that much more risk as a result. But as the bull market kept on going, and as they started to print out more and more paper, by the time you got to the end of the 1980s, there were so many fraudulent companies involved with the whole thing, and the spread started to narrow so much. Everything that Milken created, everything that he saw originally in the high yield market at the beginning of the 80s was all gone.
That's a great.
I would say the analogy is the same thing for private markets. It was good. You were getting paid because there was no liquidity. Like you were, you couldn't get out of this. This is private market. It's not the public market.
Right.
But now the spreads are just not enough.
That is a fantastic analogy. Like that is just awesome. And it's a little bit reminds me of the Warren Buffett line about what what the wise man does in the beginning, the fool does in the end.
Right.
And you're absolutely right. The private equity, when it first came out, they were buying stocks or companies at discounts to the public markets, and you own those for the long run, and then you would sell them at at the market level. But now they're actually overpaying. And the thing that drives me kind of insane is that the reason that they're overpaying is because people don't want to have the marks, like in terms of the volatility of their portfolio. And what is that? Cliff Asness, he calls it volatility laundering. And it's just,
isn't it funny how volatility comes up over and over again in this conversation?
but it's shocking that you would go, and I've actually seen on Bloomberg, I've seen PMs interviewed where they'll say, well, one of the great things about owning private credit is that we don't have to explain to our customers when we mark down 5% in a quarter. because the reality is they don't mark down 5% in a quarter because all the marks are kind of made up. Anyways, I know it's much more complicated than that, but it does shock me, and I am with you that I worry that there'll be some sort of event in there, and I haven't figured out the best way to play it. But one of the things is that, I always joke and say, I have a buddy that says, what the problem with 3 Sigma moves is? They always turn into 6 or 7 Sigma moves before they, and I feel like that's kind of what's happening. And ironically, is that kind of not what you're also saying for the whole financial market as a whole? Because you're,
I mean, I like Cliff Asness's his take, and he's a quant guy. Really, wherever there's volatility of suppression, there's risk. And the question is about the timing of that risk crystallizing. You can make bets against it over and over again, but really the question is when are those risks going to crystallize? Because when they do, the suppression, it's like you pack something in really tight, and when you open it up, it just like everything flies out. That's kind of where the financial markets are now. Is that we've suppressed a lot of risk. People are bidding up a lot of things. It seems like it's all good, but at some point, and I think that it's really when the economy turns, that's when you'll see where the bodies are buried.
So, Ed, you're an old interviewer. You used to do this for another shop. If you were interviewing yourself, what question would you ask yourself?
I would ask myself, what have I been getting wrong?
You're a tough interviewer. You're a tough interviewer on yourself. All right, Ed, what have you been getting wrong, buddy, and why?
Yeah, I think what I've been getting wrong is the ability for this cycle to continue on despite 5% increases in interest rates. I think that a lot of people have gotten that wrong, and then the question is like, so what does that mean? I think that you have 2 options. One, that your framework was wrong altogether and you need to redo that. And then the second is that it just means that the outcome is going to be more pronounced. And I think that, when it's like when bears throw in the towel, when people throw out their paradigm, who, were in disbelief at something that should have been disbelieved, that's when bad things are about to happen. So I'm not throwing the towel in quite yet. I think that what's happened is that we've had the wherewithal, and it will continue for a while. There are no signs on the that are nearby that it won't continue. But when it does stop, it will be more difficult of a workout than I thought it would have been.
Got it. Okay, that's great. All right, let's end with some questions. What do you think is the hardest thing to do in trading or investing?
Yeah, I think the hardest thing to do is exactly what I was just talking about. That is to recognize when you're wrong and then to cut your losses. And the question is to decide whether or not, why you were wrong and whether or not to put the same trade on again at a different level.
Got it. All right. So Don Cox used to say that you shouldn't invest on what's on page 1 today, but what's on page 16 today on the way to page 1 tomorrow. Do you have any trades or ideas that you feel would get the Don Cox seal of approval?
Well, actually, I was going to go outside of the investing world with that.
Sure, you're welcome to. Let's do it.
Okay. So I saw something, and it's not in front of my computer. A guy, he was talking about climate change. He was talking about migration. And basically what he said is if you look at the numbers, really there's no migratory problems because of climate change. It's really a problem with the Biden administration and the fact that their policies are terrible.
Okay.
And so this is a page 16 story. What I think is really happening is that a lot of people are going to be saying that in like 5 years from now. but they're going to be saying it in a lot of different countries. They're going to be saying it in Germany. They're going to be saying it in the Netherlands. They're going to be saying it in Canada. And the reason they're going to be saying it is because actually they're thinking narrow. They're thinking about their own specific country. They're not thinking that it's happening everywhere. I think that the migratory crisis and climate change are real, and that it's going to have a huge impact politically and therefore financially.
Wait, so I don't see what you're saying. You're saying that everyone in their specific country just views it in an isolated manner?
That's right. I think that they're going to view it in an isolated manner more and more over time as a immigration problem.
Oh, I see. Whereas you're saying it's really a climate problem.
Exactly. I think that, the more that the climate problem happens, the more you're going to have the immigration problem, and the more the immigration problem will become the whipping boy, and people will completely lose, because it's going to be so overwhelming what's staring them in the face right there that they're not going to be thinking about climate whatsoever.
I got it. So they'll attribute it to just a immigration problem in general, not realizing that it's actually climate. Okay, so one of the things that we do is we ask the previous guest to leave you a question for the next guest. And so last time we had Jonathan Lansky on, and he asked the following.
My question is quite simple. If you weren't an investment pro, what would you be doing for a living?
All right, Ed, what would you do if you weren't doing this?
Yeah, two things. One, I would be like a language teacher.
Because you speak German, right?
Yeah, actually, this is kind of ridiculous, but I speak 6 languages, and I'm in the process.
Come on, you got to tell us all 6.
So it's English, Swedish, German, French, Spanish, and did I say Dutch? I can't remember.
No, you didn't say Dutch. Wow, that's Dutch. Unbelievable.
And I'm trying to learn all of the other Romance and Germanic languages so I could round it out.
What, just for like a weekend activity?
Yeah. So,
hey, Ed, before you tell us your second one, there was this reporter. I can't remember who they worked for, but it was one of these reporters that would go to an international event. And you know how you kind of can get picked up by different kind of news organizations? And he was like you. He could speak 6 or 7 languages. So he would do like the Swedish one and then go do the German one and do the English one and the French one. And it was just wild to see him go through them all.
Yeah, I went to the Netherlands, and I did a tour around the Netherlands in a boat. You know how they have the those grachts or whatever I forgot the English word for them. But the guy, he switched between 5 different languages as he was telling it, and that was when I got hooked on languages. I was like, this guy, man, I've got to be able to do that.
All right, so what would be the second one?
The second one would be like, I think I would be a cyclist. I would be like a back in the day, what they would call the sprinter. That's a guy who, on the Tour de France, he might not make the cut because like he's so heavy that he's like heavy in cycling is like 180 pounds.
180. Yeah, the other guys are like 5'5" and like 130 pounds, right?
But when you're going up like Mount Ventoux and it's an 11% grade, being 180 is a huge disadvantage. So I would be that guy. So I would be a sprinter in cycling.
I like it. All right. Okay. So what question are you going to leave for the next guest?
Yeah, I was thinking about that. I don't know what the question is. I think I don't want it to be too generic, like what keeps you up at night, etc. But I would say if you were forced to do one sport every single day, and you couldn't do any other sport, and you could only do this one, but you had to do it every day, which one would it be and why?
That's a great one. I like that. Okay, so we're going to end with this question that I used to attribute to Ted Seides from Capital Allocators. Someone told me it might be from Patrick O'Shaughnessy. I'm not sure who it's from. Whoever it is, it's a great question. I'm going to steal it. It's, what was the kindest thing someone has done to help you along with your career?
Yeah, actually, let me just tell you, you told me that you were going to ask me that, and I had been thinking about that one question, and I think it's always a hard one, to be honest. But I was thinking about it, and I came up with something.
Okay.
So after the guy from the Netherlands did his thing, I learned these languages, as you know, and I ended up going to the Foreign Service. And when I went to the Foreign Service, in the beginning class, they allow you to bid on all these different places. So I bid on like Quito, Ecuador. I bid on Norway. I bid on Germany, and Germany. Out of my top 5, 4 were in Germany. And so when the picks came in, they showed me mine, and it was Jamaica. And I was like, and it was also like in the consular section. So it was like in Jamaica, in Kingston's like a visa mill, because you're just like rejecting 100 people every hour. So it's just drudgery. And so I was just like, I said I wanted to go to Germany. How? And I speak like 5 languages now. Like, why am I going to Jamaica? And the best thing anyone ever did for me was the woman who was making sure that people got matched in the right way. She intervened for me, stopped it from happening, sent me to Germany.
Oh, that's
and
great.
I probably wouldn't be talking to you now, because, it turned my world around. It made me a much more sort of like knowledgeable, worldly person, because I had that opportunity.
Well, that's terrific. Thank God she did. Otherwise, you would just be like a Jamaican surf bum just hanging out.
Exactly. I would be.
All right, Ed, it's been a pleasure having you on. Why don't you tell people about your letter that you write, where they can find it, how it all works?
Yeah, so it was in front of the paywall at Bloomberg.com earlier. It's called The Everything Risk, Kevin. And if people want to get it now, if they're a subscriber to Bloomberg, they can get it, The Everything Risk newsletter. So just type that in. The Everything Risk on your Bloomberg terminal, or at Bloomberg.com, and you'll find me and hit subscribe.
That's awesome. So it's Everything Risk. And do you also write for one of the blogs, like the Live, M Live or something? Or
I used to write for M Live.
That's old.
Now,
okay.
Yeah, now I've moved over to the FX Rates team. Like I'm the team leader for America's FX Rates. And then I also have the Everything Risk as well. So unfortunately, I only write every once in a while for M Live.
Okay, I got it. All right, Ed, it's great chatting with you. All the best to you and your family in this holiday season. And thanks for coming on. Let's not let it go 4 years before the next one.
I know. I agree. And next time we'll do it in Toronto again.
That's right.
Let's try that.
Thanks again, Ed.
Take care.
Take care. All right, Patrick, talking charts. Lots happened. I'm looking forward to hearing what you think about the markets.
Unbelievable, right? Okay, before we do, let's go through the top 3 things we were watching. Okay, number 1 was the inflation numbers, and they came in line on the tame side. And I'm not shocked. We talked about it with oil prices as low as they are and gasoline down, heating. No, the point is this was not when there was going to be an uptick in inflation. It's not that one can't happen. It's just not. It didn't feel like this was the month that there was going to be a surprise. Number 2 is the jobs numbers, and they came in as like nothing's wrong. Like this.
Well, I think they came in even better than that, Patrick.
Yeah.
They were actually stronger because don't forget the previous job month, we had all the talk of the SOM rule getting triggered and recession was coming, and all that talk disappeared with another strong unemployment number and or employment number, and recession talk is off the table.
Do you how do they discount or is it accounted for? Sorry, when seasonality, like usually
that should all be in there. What's interesting though is that there was a lot of talk about the fact that I guess there was a couple auto strikes or some sort of strikes where the workers came back and they attributed the strength in the employment rate to that, and everyone was like, well, wait, shouldn't that actually be all priced in? Meaning that everyone knew that they were coming back, so why was that a surprise?
Yeah.
It is still, we still ended up down ticking in terms of unemployment.
And
Economy is stronger than everyone expects.
Yeah. And number one was the FOMC, and that deserved to be number one. And it was number one. Unbelievable. Like,
It really was.
You know what? The one thing, like, I just didn't think Powell was going to throw gasoline onto a fire to get it burning hotter. Like, I thought they were going to calm everyone down and say, listen, we still have a lot of work to do and this and that. But no, they came in full on Dove.
Yeah. And you have to ask, well, first of all, there had been all sorts of signals that they wouldn't push back on it because they'd been given lots of chances to push back on it in the previous couple of weeks, and yet they didn't. So you have to then ask, why aren't they pushing back? But you're right. Not only did they not push back, they seemed to almost fuel it with going a little bit farther in terms of encouraging the market to price in some extra cuts. Now, having said that, Patrick, this morning, we're taping this Friday at lunch, but this morning, John Williams, the New York Fed governor, he scheduled a previously unscheduled appearance on CNBC, meaning he got on and said, listen, I got to go and talk to the markets, and tried to talk it down, tried to, take those rate hikes that the market had priced in for 2024 out of the market. Thing is, he doesn't look like he's that successful.
No.
The market is just saying bullshit. We don't believe you.
But there's the kind of feedback mechanism is that the more the market prices in the cuts, the more easing that they're putting into the system by rates being pressed down, which is actually decreases the need for the Fed to actually act.
Yeah, it's like you're in Inception.
Yeah, but it's so weird. Like, so the fact is that the more the market gets excited about this, the more chance that that
they're going to be wrong and not need to do it.
Yeah, it's
It's
interesting. Okay, so let's talk about the top three things we got to watch in the going into the year end, because this is going to. Our last episode is going to be in between Christmas and New Year's there, and so this is that kind of gap. Well, obviously we had the pig in the python of news this week. And really, there's very little on economic news front going into the year end. I mean, maybe the jobs numbers in January is the next kind of major thing. But so there is, though, next week, the Bank of Japan monetary policy statement. And obviously, there's been a lot of volatility in the U.S. dollar yen, and the Nikkei continues to do very well. But what do you think that there's going to be anything that's going to come out of
No, well, the Bank of Japan came out and signaled that they would not be changing it this month end. So don't expect anything. Having said that, maybe that was a bluff and that they really want to surprise markets. I don't see it. They are going to pull off a ZERP. They are going to raise rates at the front end. I don't think they're going to do it in quiet December trading.
Right.
One more month we have to wait.
Yeah, that sounds about right. So number two, fading the Fed reactions. And I mean, I guess in theory, number two and number one are going to be similar. But the fact is that we obviously had this burst. We'll get to the charts in a moment in all markets. The moment the FOMC
across
talked,
the board, commodities, dollar,
everything,
bonds,
gold,
stocks,
the whole thing.
So the real question is going to be, which ones do you fade? Which ones are going to continue? And how is it going to play out from here? But there's lots of people that are putting back on the commodity trade. There's lots of people selling U.S. dollars. Lots of people reaching for stocks. Anyways, let's get to number one.
And number one is Santa coming to town? Let's just get to the charts and talk.
Well, you should tell people what that means. It's
Santa Claus rally.
There's a Santa Claus rally that everyone talks about. The thing about the Santa Claus rally, Patrick, is that a lot of times it's actually much more a small cap affair, and everyone focuses on like the S&P, but it's much more pronounced in the small caps.
Yeah, kudos to you, because you've talked about that over the last couple episodes, and even Nick, another bud of mine, was in that same camp, and I didn't want to drink the small cap Kool-Aid.
Yeah, you don't like the small cap Kool-Aid.
No, actually, it's not true. I don't mind during growth cycles and periods of easing, anticipating that small caps will do well. I just didn't want to drink the Kool-Aid and that this moment was when they were going to outperform.
Ultimately, I guess that comes down to the fact that you were expecting a recession. Now all of a sudden the chances of recession have to be at least diminished in your mind.
Oh, no, absolutely not.
Oh, really?
Absolutely not.
So you have not changed your
Yeah.
probability of a recession based upon the Fed
the problem
easing?
is the problem is everybody keeps they react to what the market sounds. So the market presses new highs. Oh, that means everything must be okay, and that's nonsense. Like
No, but forget about the market, because you're talking about what's priced in. But I'm just talking about the economy itself. You don't think that this week's action by the Fed did not change your calculus on the odds of a recession in 2024?
No. I don't think so.
Why is that?
Because in the end, almost every recession and an inevitable rate cut cycle, stock markets don't start to decline until they're already cutting. Like they were.
Yeah, but forget about the stock market. I'm just talking about the economy. Why don't
you're saying that that suddenly a mortgage rate goes from 6% to 5.5% or 5.25%, and suddenly a recession is been avoided? That's complete nonsense.
I'm saying that the probability of recession
I don't think it's
diminished. So your argument is we've just gone too far already, and there's no coming back.
Absolutely.
So if the Fed lowered rates to 2% tomorrow, you wouldn't change?
Well, here's the thing. Okay, the mildness of the recession. Like, so maybe the fact that they're starting to potentially put in this ease may make it an incredibly mild slowdown. It may not be like, if they kept hitting the brakes hard, then it could have been a really hard landing. But I still think we're going to see some form of an economic recession. Absolutely. And it just might be more mild, but it's coming.
So I'm not disagreeing that this doesn't mean that the recession is off just because they've lowered rates. All I'm saying, the
severity of the recession, well, I would say that.
But I would argue there's not just the severity. I would argue you'd have to change the probability. And I guess that's where we differ.
Yeah, no, I don't think,
because I think before they were driving. Listen, before the market had assumed the Fed was going to stay tight, even as inflation went, as inflation lowered, and therefore real rates would rise. And whether you use real rates in the kind of here and now inflation, or even just use inflation swaps, real rates rising, would theoretically tighten the market more and potentially cause or increase the chances of a recession. And now with the Fed saying we're willing to lower rates as inflation comes down, at the very least, you got to say that there's less of a chance. That's all I'm saying. I don't know what the numbers are. Let's just imagine
I will
60% before. Like, I think that with the Fed changing, you got to go to 40%. And I think that's all that's happened.
That's happened is we've had changes in asset prices.
But see, I disagree, because you've had changes in the actual Fed's guidance about what.
Yeah, but how does that affect small business or medium-sized businesses?
Because now
credit's
there's
cheaper,
a good chance, that when they have to go refinance, instead of refinancing at 5.25% or whatever, so they're going to have a spread. But let's just imagine instead of refinancing with a policy rate of 5 3/8, they might be refinancing with a policy rate of 4 3/8.
Yeah, and the fact that you think that kind of a difference can cause a recession to be avoided is nonsense.
No, I'm not. I'm saying that it increases the possibility that it might. That's all I'm saying.
Yeah,
I'm not saying that.
I'm going to stand by my view. It is going to simply mean that it could be a more mild recession. That I will agree upon. But the odds that suddenly there's not going to be one, no, I'm not going to. No. Enough lip flopping. All right, so let's talk
the small cap Kool-Aid.
I don't. Yeah. So no. Anyway, look. But the small caps, what a move. What a move! Like, congrats to all you guys that were making that call. It's an extraordinary burst. I mean, for a 1.5 month move of 25% from the trough to peak is insane. That's
now that I'm looking at the chart, it's getting a little scarier looking.
Yeah,
but I've been busy thinking about it from a fundamental perspective. Now all of a sudden you're bringing the chart up and making me stare at it, and I'm like, oh Jesus, it's ugly. Like it's gone straight up.
It's gone straight up.
Now, having said that, here's what I'm going to push back on you in terms of like saying that's overbought and that, maybe it is overbought over the short run.
No. I'm not saying that.
Okay.
I actually am giving you guys kudos for being in. I'm not. I'm not fading this.
But I would say pull it up against Qs or pull it up against Mag 7, and it's like this move is still minor, and it has a long way to go.
Here's your Russell Nasdaq.
Yeah. Look at that. Like this move is just starting.
But my opinion though is that that the strongest move here is going to be on the recovery period on the other side. In other words, I agree.
We have a recession again.
We
might not. We might not. You're like, listen, I'm open to the idea we might not. Everyone is being shocked at the fact that the economy is being stronger than everyone's expected. I still go back to my buddy Dario Perkins from Lombard. This is not a regular business cycle. We sent everyone home. We mailed them checks. We reopened the economy halfway. We then reopened the other halfway. We closed China. We then did the stimulus bill. The regular business cycle is all messed up. So I'm just open. I'm not saying you're wrong. I'm not saying like there's no chance of recession, because I do believe that we are going to have a recession eventually. But I'm just saying I'm not as convinced as you that it's for sure coming. And especially now that the Fed has shown that they're willing to lower rates even without inflation hitting their target, and even as growth is still positive, as employment's still high.
Your observation and Dario's observation, I will not push back. In fact, I completely agree. It's a different cycle. Like the huge insertion of cash that came in to offset the COVID shutdown is something that changed the business cycle entirely. But you can't at the same time go and raise interest rates 5% in less than 2 years on or several $100 trillion of credit stock around the world and say, oh, don't worry, everyone can handle it. That's nonsense.
But you might be able to if you spend enough on other infrastructure stuff. So I'm not disagreeing with you. In the absence of any fiscal, that would be just completely destroy the economy. But if you spend enough on other infrastructure stuff, and I think the one part that's getting missed is this Inflation Reduction Act, or whatever it is, like basically Biden's bring it home, kind of expand manufacturing at home. That bill, it's just kicking in now. That's the part I think a lot of folks are missing. So they've allocated the spending, they've gone out and borrowed it, but it's gone to the state, and it just takes a while to get through the system.
Okay, I don't think my thesis, even for the last year or two, was that this cycle was going to be different because the last financial crisis started inside the U.S. and like a contagion made the rest of the world sick. And this time around, I think it's the opposite. I think it's the rest of the world that breaks and then inevitably trickles into the U.S. And you're talking about U.S.-centric things. The problem is that this interest rate move was not a U.S. move. Almost every developed country went through an inflation surge and subsequent huge increase in interest rates. The rest of the world's going into recession, even if the U.S. has some sort of infrastructure bill.
Okay, I'll accept that. I'll accept your argument. But the U.S. can they are so big, they can go on their own if they spend enough.
Yeah, maybe
they can. Their economy can handle the rest of the world going into recession if they spend enough on infrastructure on their own. They can do it all alone.
If all three arms of the U.S. government were blue, I would have drank your Kool-Aid. I don't think going into a political thing. I just don't see that this.
Everyone always says that to me. They say, "Oh, they're gonna stop spending." I don't see any signs of them stop spending. Like
it's not about stopping spending. It's about the fact that they can't spend at a irresponsible rate.
Why? Because the
And
bond
that's-
market's
and
because
that-
the bond market's going to push back
No,
on them? But the
no,
bond
big-
market just went from 5 to 4, and think about all the high.
Why would the Republicans in any way make the Democrats look good by juicing up and saving the economy in this cycle?
But it's already spent. That's my point. It's already done with this Inflation Reduction Act. It's just getting through the system. Anyways,
All right. Well, we'll watch.
agree to
Okay,
disagree.
let's talk charts.
Okay.
All right. So let me get some crayons out here. Okay. So the first thing we want to talk about is the Santa Claus rally, and the question is how much did Santa just come early? Like this surge is now heading right to 2021 high. Right, like we're at that 4,800 level. So I'm doing the cash index because futures, because of the contango, are already at these highs. But on the cash index here, we're 100 S&P points away from a double top retest of a major high. And the big question, does the stock market bump its head there? Or and does resistance actually develop there? Or are we going to just rip through it like a hot knife through butter? And that's a thing to watch. I think on balance that it's at least going to bump its head there, and that may at least the highs. If the market's going north of 4,800, I think it's a January story. I think that any Christmas rally here is a few more percent at best, and then we're going to get into a low volume, low vol environment trade range that's going to probably define the holiday season.
All right. I'm not disagreeing. I think that the looking at the S&P is the wrong index now, and not the wrong index, but the wrong index if you're bullish. Because I think it's
you want small caps again?
Well, no, I just think what I'm saying is that although I'm kind of constructive on risk assets, I think you have to be really careful how you define risk assets, because the world is over owns the Mag 7.
Yeah.
And the Mag 7 are such a large portion of the S&P 500 and
even more of the NASDAQ, even though the year was rebouncing.
That's a great point. Let's talk about that, because it's interesting that the NASDAQ, which now like the S&P 500, their index committee doesn't have as much leeway in terms of when it comes to tinkering with the different weights of stocks in their index. Basically, they have to define blocks that are kind of controlled that they take out, and then they have to use that market cap, or the float in terms of the number of shares. Having said that, the NASDAQ 100 has more ability to change it so that they can push back against the concentration problems. And so the index committee can tweak the index and make certain stocks less large than they would be given their actual market capitalization. And they took this opportunity and caught the market way off guard, by the way, on this, because very few were expecting this, and reduced the size of the Mag 7 within the NASDAQ 100. And I think that day, remember that day we had, I think the Mag 7 was down 2% and the NASDAQ 93 was up like 2%.
Yeah.
And that was because we had those stocks, all the money that, pre-positioning for people selling the Mag 7 and buying the other 93 stocks. But I do think it's interesting, Patrick, that they took the opportunity because they viewed that the concentration was too large. And I wonder how many finance committees are going to meet kind of in the new year, look at their portfolio holdings and come to the same conclusion. Right?
True.
Like
it's entirely possible.
Yeah.
Like, but what's interesting? Okay, so let's just look at this NASDAQ chart. It's pretty freaking bullish. Like the upside momentum on the NASDAQ, it actually looks very clean. I mean, that the surge in the last 5 days is not much different than any other bull impulse that we've seen, and this thing easily measures to 17,500 on the upside, and may continue, especially considering that this thing is pretty much already making new highs. The interesting thing, but to your point though, is other than Apple, which, when we look here, Apple actually looks like it's still bullish and following through and making a little bit of a higher high. But then you go through the other mags, it gets far more sketchy price action.
Yeah,
like Microsoft.
They haven't been leading for a couple months now.
Well, I wouldn't say couple months. Maybe on a relative basis,
Yeah,
but
that's
definitely
what I'm saying. Relatively, they haven't been leading the NASDAQ.
The true, though, divergence has only been 2 weeks old. Like the period where the stock market, unless in the post FOMC surge that rocketed the market. For instance, Microsoft is literally flat on performance. Google is flat on its performance since then, if not even down because of that gap. Amazon literally just maybe moved a little bit to the upside, right? Tesla just trading at the top end of its 1 month range. Like we haven't seen these other stocks do anything remotely bullish.
Yeah,
and
you saw the Goldman Sachs hedge fund data showed that the concentration of these stocks within the hedge fund community is an all-time high.
And what's the thing is that the more it underperforms, the more it guarantees that they will fail, because the one true thing about the markets is that almost all hedgies and all money managers are always trying to beat a benchmark.
Well, they're chasing momentum.
They're chasing momentum and beating benchmarks. Yeah. And the thing is that if they're overweight this stuff and it ain't moving while the market's going up, they're going to look like shit.
Yeah, 100%.
And so they have to then be forced literally to rebalance because they're not getting the performance they were used to that the Mag 7 was offering them over the last year.
And if you look at the Goldman Sachs, what they call the VIP index, which is the top holdings of hedge funds, and then you compare it to the most short rolling basket, we just had a couple of days of the worst relative performance that we've had in I think in the last few years. Meaning that hedge funds have lost their longs have not gone up and their shorts have gone up. And I think that you're absolutely right that becomes a self-fulfilling prophecy where they end up unwinding that trade.
And it doesn't even have to be them abandoning the mags. They just need to go from being ridiculously and irresponsibly overweight to being equal weight.
Yeah.
Right? Like they basically are just going to start
I'm with you, Patrick.
rebalancing their weight.
It's not like they're going to go short these things.
No,
it's only idiots like me do that.
All right, I was gonna say something, let's talk. Let's talk the dollar. So, the dollar obviously broke down, and obviously it's driven by the fact that the signaling of an easier Fed doesn't necessarily compute to what the other central banks around the world are saying, which remain diligently tight.
Well, so I'm not sure I would agree with that. I think a couple are, the ECB are, and maybe
the big ones.
But yeah, okay. Well,
yeah, I mean, Bank of England wasn't exactly dovish.
Well, and I would say that the Japan's is pushing back and refuses to tighten, so that one's easy. So I don't know if I can just accept that, but you're right. On the whole, let's just put it versus expectations.
On a currency,
it changed the dynamics.
There wasn't that much dovishness coming from the Bank of Canada either. Am I wrong?
No, you're right. But let's just agree though that the real important part is versus expectations. The Fed changed the calculus,
and so to me, that does put immediate pressure for the U.S. dollar to follow through. So back to our second point, which does the Fed reaction fade? And while it might fade on equities or other places, I don't think it fades the dollar. I think the dollar is going back to retest the year lows. And it's not that far away. It's only 1 or 2 points. But I even if the dollar does ultimately bottom and reverse, I think a trip down into the 100-101 zone on the Dixie is the path of least resistance here.
And Patrick, to your point, I think that would also coincide with the move upward in the S&P to the highs that you were talking about.
Yeah, like and that could be the story for the next 1 week,
Yeah.
and then when we're doing this next episode of the Huddle out in let's say 2 weeks from now, I think we'll have a much different picture.
So you're basically a buyer down lower.
I not so sure. We'll see.
Okay.
I want to see the inner markets develop a little bit more. I obviously still think 2024 will be a lot more challenging than everyone who's drinking this. Everything's fine because the Fed is pivoting shit. But
just so you can be clear, I'm not saying that. I was just saying that you have to change the probabilities. That's all.
Yeah. So so let's
still
talk some commodities,
according to Patrick.
Yeah.
Okay.
So let's talk gold. And what I find really interesting here is that obviously popped higher, but we're actually at such a very interesting moment again because the fib zones lie right along its major spot price highs before the little prairie dog pop and drop kind of.
Can we talk about this? Because I think, did that not happen? I guess we taped Friday and then we had that explosive Sunday night move 2 days later, right? And we haven't had a chance to speak since then.
Yeah.
Right. So I was talking to Cuppy about this, and Cuppy's like, oh, Jesus. It's just like you said, because I always talk about the Sunday night oil gap that you needed to fade. Remember, there was that big Sunday night, everyone woke up and you got on Twitter and everyone was talking about oil going to, I remember it was like, is it going to 200 to 300 or only 200? That was kind of the sentiment out there. And yet this is the same kind of opening up Sunday night, huge rally out of nowhere. And then it just, boom, gave it up. It was a shocking couple of days. It was wild. Like, don't you think? Like,
it was wild. It was wild.
I think that was like some of the most crazy gold trading that we've seen in a long time. I still can't understand why they got up. I guess it just broke a whole bunch of technical barriers. There was nobody left to sell. And then all of a sudden, some real sellers woke up. And next thing we knew, we had trapped a whole bunch of week longs up above. Next thing you know, we're $150 lower from the highs. Like, how much have we declined from the highs?
From the highs was $150. Yeah. We went basically from 150 to 2,000. I'm rounding it up, obviously. But
now the one thing I will say, I feel like I still like it, and I think it's still headed higher. And to me, that was just a shakeout.
What all okay, well, so I intentionally had it on the weekly chart for a reason. Okay. So all the major highs up here, that was that 2,080 level. Let's just round it. And even on a monthly close basis, from a closing perspective, we actually had 2,000. Like, we never really had a monthly close above 2,000, even though we had these little shadows that popped above there, right? So this, by many accounts, is already still very bullish price action. But when you look at it on a weekly chart basis, this is still a very bullish chart. Higher highs, higher lows, all dips are being bought. It is, in general, has done nothing wrong other than gold bugs get excited every like it's supposed to happen right here, right now, and every little uptick is it proves it's working, and every downtick is someone's manipulating it. And it's true though.
It is. If oil goes up $150 in a day, it's the market's waking up to the real value of gold. If oil goes down $50, it's, God damn it, they're manipulating the thing again.
Exactly. It's the way it works. But this is still actually a very bullish chart. My view though is that I really think that the next true bull advance, it comes on the back of when we're already deep into the easing cycle. Like that's it, when easy money, lower interest rates, all of that kind of stuff at the tailwind is when gold really shines. So I think on the short term, gold has benefited from the fact everyone pulled the easing cycle forward closer to us, and that got every gold kind of getting this momentum. But at the same same time, what would be really on a big picture monthly and weekly chart basis wrong with gold spending, the first quarter of the year, creating a base platform from which it's going to launch its real bull advance later in the next year? I'm bullish, but I'm not so sure it's immediately bullish.
Oh, that's a good point. And to your point, Patrick, if it is central bank buying, which I do believe that it is, I do not believe this is driven by investment or driven by India or China. I think it's driven by China, but China's central bank, not like Chinese people themselves. Then they're not going to chase rallies the same way that, retail or even hedge funds do. So this is just kind of the new type of trading that gold is. And I think that I think you make a lot of sense there with your argument that we could just go sideways here and as they accumulate more until we get the next move up.
To me, when you look at a monthly chart on gold, right? When we go through weak dollar easing cycles where gold performs the best, I mean, we could easily have 100% move in gold.
Oh,
I mean, we could go
talking.
but like it could go from 2,000 to 4,000.
Yeah.
But I just don't think this thing popping to 2,200 here and getting everyone excited and then consolidating back to 2,000 or 1,900 and kind of grinds for 4 months before the thing makes its real big move. I think everyone just needs to be far more realistic on their time frame. That's all.
Was that a monthly chart you were just showing?
Yeah.
Because God damn it, that's a sexy chart. That's
It
like
is-
seeing
it
your
is.
that's like seeing your first Trans Am.
Yeah.
That is a sexy that is a sexy looking chart.
Yeah, it is. It's a nice Trans Am. Yeah. Anyway,
Do you remember seeing your first Trans Am?
Yeah,
as a
I
kid?
remember. It's the Mustang for me, buddy.
Okay, sorry. I'm more like a Smokey and the Bandit with the big Firebird.
There you go. Moving on, I just wanted to highlight, like, copper's been strengthening a little bit here.
God, has it got the PhD? Is the economy fine now?
No, I actually just think it's trade range, and I'm a seller on the idea that this breaks out north of $4. Even though I think on the short term it definitely can grab 10 cents on the upside. I'm just skeptical that this is the real deal in any way.
Just be careful, because it sounds like your fundamental economic views are affecting your voodoo
It's
magic
possible.
views.
It is always possible.
Yeah.
But I mean, look, it did find support. It is making higher highs and higher lows as it's rolling over above its moving averages. So yeah, if you're observing those kind of technicals, but when you're observing those kind of technicals, they tend to only be a focus on the most immediate move ahead, which is some multi-week advance, which I'm implying, I think we could easily go to $4 on the upside. I just don't think that this is the big one where we're starting a new bull trend in copper yet.
Okay.
On that, let's though talk about the ugly, the natty, the widowmaker. Once again,
So ugly.
creates many widows.
Yeah.
How many people, $3 is enough, $2.80 without buying here, $2.70, $2.60, $2.50. This thing, it hit 2.25 on the Jan contract. It hit 2.10 on the Feb.
Yeah. Listen, it really is the toughest commodity to trade.
But you know what? Everyone, they came out with all those headlines on, like, maybe I don't know the market good enough, and I want you to make a fool of me if I'm wrong on this.
I know enough to get myself into trouble, that's all.
The thing is that there was all these headlines about warm winter, right?
Yeah.
Like this is a thing. But the term structure of nat gas got killed more than a year out. Like, it was the entire term structure completely dropped.
I think I completely agree, Patrick. I think that it's the same deal. The shale guys are pumping too much nat gas.
Thank you. That was about to say that it's the warm weather argument is shit. I think it literally is that they fired up all of the shale. They have too much of this nat gas, and they can't put it on ships fast enough to, and they have to like literally burn it off, dump it at any price.
One thing I will say, Patrick, is that when you look at the Boyle contract, which is the triple nat gas contract, it had gotten huge in terms of its size as a percentage of the open interest. Yeah. And don't forget that this creates a situation where, in essence, it's like short gamma. So as it goes lower, they need to sell more. And as it goes higher, they need to buy more. I was hoping that there would be a weather event and we would have a situation where that short gamma effect would actually cause it to rally. In my opinion, it's actually caused the opposite. So we had a good weather. And it's been exacerbated by the fact that there's all this boil and there's extra to sell on the way down.
Yeah.
So I do think you need to be kind of keeping that in the back of your mind.
Yeah. Uranium, U308 at 85.75.
Yeah. Well, good for Cuppy, man. He's nailed it.
Yeah.
And he's just being so good at just
tell me when you buy so I sell to you.
Yeah. I'm not touching it.
That's exactly when you finally succumb and you finally put some shit on the books. Just let me know first.
Okay,
I bought some.
Yeah, I'll buy it. From
let me
you.
know.
I tell people whenever they say when they do that, you just journal it into my account. So if I buy some, I won't buy it in the open market. I'll just take it out of your account.
I'll journal it over.
Yeah. Okay.
Just tell me when you want it. Okay.
Good for everyone. All the uranium bulls that hung in there. Good for you guys.
Yeah.
Terrific. Like I blew it. I got cute and I gave it away too early.
Yeah. I wanted to talk to Ag Stocks for a moment. This is the Moo ETF, and they were so ugly, these charts.
So what is in the Moo? I don't know this one.
Like a Nutrien and CF
it's like ag companies.
Yeah. Yeah.
Okay. I get
right.
it.
All the Nutrien, CF Industries, Mosaic. You know all the.
I'm looking at it Zoetis. I don't even know how to say that. Deer.
Yeah.
ADM.
Anyway, the ags.
Yeah. Okay.
It's all ags. And like, for instance, Nutrien was such an ugly chart. And this stuff is like small caps and all this other stuff's rallying, and you could not get even a reaction from the ags. They were left dead. And then suddenly, middle of this week, you get this bull breakout candle, substantial reversal. I can't figure out why.
It's the Fed.
But the Fed is buying ag?
Oh, it's just
but the point is that the market was rallying for the last month, and I get it. Like, okay, the Fed, there was buying surge there, but why is it that the ags decided to wait this long and suddenly now this matters?
So I hear lots of people asking all sorts of questions about this last week and why is this happening? Why is this happening? And the one thing I will say is that we have lots of rebalances in terms of like within the index themselves. We have an OPEX. We have people moving their portfolios around. Don't read too much into any of these moves.
Yeah.
Like don't sit there and look for fundamental reasons when often it's just flows. Flows over bros.
I think that this can obviously have a little bit of follow through. So maybe this thing makes it even to $80 from 76 where it's currently, and you clip a quick move. But what will be really interesting is whether or not this starts shifting into being accumulated and dips being bought, or whether this was exactly that, just a quick little reaction and it's faded, and we find this thing back at $73 by the middle of next week. If it is, like, that's very bearish. If this thing's back to $73 by the middle of next week, you sell that thing because it's going down to 65 easily.
I think our buddy Rupert, the blind squirrel, is a big fan of ag in general.
Well,
Brazil,
listen,
especially. I'm going to be on his side. I'm going to be on the long side.
Listen, I actually would love to catch the bottom on this ag story. I just need to see that we've seen some sort of bottoming formations, that this thing is actually turning. I'd rather get in at the second inning of the game and know that this vicious bear market decline has finished, rather than being a rock star here and then still catching one or two more legs down. That's
why you have all your fingers and I'm like going around with it.
Well, you could buy gamma here. Why don't you just at least hedge it out? You won't do that. Never mind. I want to talk though. Let's talk bonds, and obviously, big surge higher. This is where I think the fade can happen.
Yeah, never going to happen because I completely agree with you.
Oh my God, you just goochered it.
Yeah. Isn't it funny how like in October there would like the shrill of the term premium pros, and like the government will be able to fund itself. Like, do you remember how loud that voice was?
Yeah. Yeah.
It's absolutely shocking. And now it's just quiet. Now people actually like bonds. So they hated it at 5 and they love it at 4 in terms of yields.
It's very likely that the 2-year bond bear market might be over. That doesn't make it, by the way, bullish. A lot of people mix up how markets work. They only think of it as binary, which is the market. When the bear market is over, it means clearly that the bull market has begun. But there's the states of where after a heavy bear market, a market can stay dead for months and years before any sign of a bull pulse can happen. I'm not necessarily saying that has to be the case, but I do think that the bear market of bonds is pretty much over. But I don't necessarily think that makes me bullish bonds. I just don't. I just think that 2-year devastation is now kind of fully priced in a new level of bonds, and they're going to stay here for a while.
So I don't disagree, but I am a little scared that you're no longer bullish in bonds. As a big bear over the long run, it makes me.
I think when the recession kicks in, this is why I'm.
What do you mean the recession's kicking next quarter? You told me.
Yeah. When it kicks in, but when it kicks in, the 2-year will go. Right, and this is where that TUA product from Harley is fantastic. You can play this. Will the long bonds? I think the long bonds will generally be a defensive place to be. I don't like, for instance, if you're, I think that there's a very good chance that during the next recession, the 60-40 may offer you some hedge. You
mean that bonds will resume as a counter to stocks as a
or a minimum a place to hide, or a high yield place to hide. I don't necessarily think that they necessarily have to go up during that period, but I think that I think that's been happening the last 2 years where stocks and bonds correlated to the downside. I think there's a very good chance 2024 the 60-40 portfolio will be more beneficial than it has been in the last 2 years.
I won't push back over, like, if you're going to talk about 1 year that might return.
Yeah. Okay. So I want to talk about global markets. First of all, Nikkei still looks like a bull flag ready to go. It will be really interesting to see whether the Nikkei can really get another bull run going. But what I wanted to kind of get you to size up for me is, what the hell happened in the Euro Stock 50?
I have no idea. Just took off.
It
just feels like people are underweight. Like, it just again feels like flows. It doesn't feel like anything fundamental.
It was straight line advance. Yeah, it hasn't even the rally hasn't been checked.
It's like somebody big was underweight or short, and they're just unwinding it. That's the thing.
What a
like,
move!
There's people think
what a move.
What a move! But everyone always thinks there has to be a reason for stuff. And sometimes it's just that the positioning got to a point where it was so offside and everyone was so underweight this thing. And then once they said, okay, well, we got to take it off, and it just kind of creates this self-fulfilling, virtuous circle.
There you go. Okay, so India on fire.
Yeah, I've given up on that, but I shouldn't have. That thing's been the best performing thing out there.
Yeah, it's running, and it just accelerating. Like so India on fire. The thing is that it's too late to chase until there's some sort of a consolidation. Like this upper target is maybe a couple thousand more points, which if you're in it already, I would continue to own it. I wouldn't sell, but it's hard to tell someone brand new that's suffering FOMO to come and start buying here. it's kind of like you missed the party, right? This is probably like 7th, 8th inning move, but it's very bullish and it's likely to continue. But the other one is Brazil. Like Brazil consolidation, bam, broke out again. Brazil is working really, really well.
I should just close my eyes and buy that one. I think that one goes up for years.
It's
and
possible.
it's not just because I like the Brazilian people. I
and
think that their stock
when
market's going to rock.
When do you think Argentina's investable?
I don't know. It just makes me laugh because I have to listen to Cuppy and the boys talk about it. I don't have a clue. I'm gonna beg off that question, Patrick.
All right.
What do you think? It looks like, I guess if you're looking at it, it's like the chart looks good.
It's a pretty freaking good chart.
Yeah. The guy's a lunatic. Like I'd rather forget about that. There's better trades out there.
All right. Anyway,
that's
enough.
Your opinion. Do you think it's investable?
I think that you have to now let it needs to backfill. Like there's no asymmetry in starting to buy like the Argentinian ETF up here at 52 after the thing's ripped in a month from 40. But if there's legitimate changes in the way that Argentina, they've always had a shit currency, always had, hard to do business there. If he changes that environment, and you are buying something that has been left behind for decades.
Yeah.
And so there could be a longer term trade there, right?
So Patrick, every day I come up with a little bit of wisdom that I put in my chat. And I just want to, I'll read you one from yesterday because I think it really
please give us your wisdom, buddy.
It's not mine. I use someone else's. I'm not wise enough to come up with anything. Bob Farrell, the famed Merrill Lynch strategist, says if everyone is waiting for a pullback to buy, either the market doesn't have a pullback, or if it does, you shouldn't buy it. I'm wondering if Argentina will be like that.
Huh? Maybe. All right, Kev. But let's move on because
Crayons with Kev. It's my turn.
It's your turn.
Okay, so we're going to do. I'm glad you didn't talk too much about currencies, and we're going to do the CAD JPY. Can you pull that up? Okay, I don't like this. To me, just looks like a big rounding top that's headed a lot lower.
Okay. So, I won't lie that this is the area that I have the least skill and knowledge in, and that's trading the pairs that are the miners, like all the different. I know all the like U.S. dollar cross current, the U.S. dollar cross. But when you get to euro yen, CAD yen, all of this stuff, like I'm useless at these. It's just my brain doesn't compute these charts, nor do I look at them, to be honest.
You really probably should because a lot of times they trade completely different and have different personalities. And I think that a lot of folks mistakenly don't look at the pairs enough. They just everything's against U.S. dollars and they don't look, CAD yen or euro yen.
Yeah,
like euro yen is one of the biggest traded pairs out there.
Oh yeah,
like I think it might be after euro USD and JPY USD, it might be the next most traded pair.
Yeah.
Anyway, so what do you think?
Well, first of all, notice that going back to 2022 are some major highs there as well. Definitely after a very, very bullish run throughout the first half of the year, it started getting heavy. Right. And so you're definitely seeing this scenario. And of course, the Canadian dollar, there's a lot of things that can go wrong in Canada in this environment. And so it's a topping formation. It's definitely pulling back. It could be bearish. And I'm not going to push back on you.
All right.
Good.
I pass again. I didn't want to do the same sort of like trend. I wanted to do a different kind of thing. So we're going to do round top.
All right. Okay. Well, a rounding top. All right. It's time to get Lena to save the day for us.
Okay. I didn't think that you needed any saving, but sure. So,
all right.
First question.
Hit us with questions.
Yeah. First question. Hi, love the show. Thanks for doing this. Here's my stupid question. bull steepening. I understand the theory, but I don't get why people are so sure about it with those long 1-year bonds, short 20 to 30-year trades. I might be taking a simpler approach, but if the Fed is done hiking, I can see more volatility out in the curve, and I want to be long 20, 30-year bonds rather than short. What am I missing? I will have positive carry, and I will have some inherent leverage buying out in the curve. I can't see why short duration bonds should rally whilst long duration fall in price, like I see people around saying. Also, QT, which part of the yield curve is affecting? If in the short end, is it an argument in favor of that steepener trade? Thanks.
You want to do it, Patrick? You want me to?
No, you do it.
Okay. So I get where their listeners coming from. And this is obviously a listener that's near and dear to your heart, Patrick, because he's thinking about it from kind of a bullish perspective. And so if you're thinking about it, thinking that the economy is about to go into recession and you're not prepared to use leverage, meaning you just want to buy the asset with the most natural leverage in it, then you would go and you would buy long bonds. And the problem with that, though, is let's just imagine that we have a situation where they lower rates at the front end. They lower, I think we're 5 3/8. Let's say they move it down to 3%. Okay, so they go 3%. We'll say the 2 years right over the Fed funds at 3%. And then you ask yourself, what is a proper yield curve, meaning the difference between the 2 and the 10 or the 2 and the 30. And a lot of times as the Fed lowers rates, the yield curve steepens. So we could have a situation where the Fed lowers rates and yet the long end actually rises in yield because as they lower rates, they're willing to accept more inflation and it ends up being that they're easier and it doesn't do what everyone might expect it to do, meaning that if we don't have a return to that kind of 1 and 2% that we had kind of the post GFC pre-COVID era, and it's just a return to a normal environment where the Fed stops at 3 or 2% and there's the regular yield curve on it, then the long end doesn't do anything. So that's kind of the problem. And that's why Harley Bassman's product, where he's looking at it and saying, forget about betting on the long end because you don't know what's going to happen with the long end. The long end is set by market forces as opposed to by the Fed. So therefore, if you really want to bet on the kind of what the Fed's doing, what you should do is you should be buying 2-year notes. And because the 2-year notes don't move as much as a 10-year or a 30-year, you have to use leverage. And so we're going to lever it up 4 to 5-1, and therefore it'll behave like a 10-year, and yet it'll be based upon the rate that the Fed does. So that's kind of the essence of his argument, that TUA. Now, in terms of QT is kind of difficult because in essence, they're not really selling bonds. What they're doing is not reinvesting the proceeds that they own as they mature. And what it ends up doing is then it is a point where it depends on what the Treasury goes and actually issues. So in terms of it affecting different parts of the yield curve, it's hard to really say because the Treasury will take into account the QT and therefore adjust based upon that. But I would say here is something I will say about QT, and this is kind of the opposite of QT. QE. QE, everyone thought is bond bullish. And I have pushed back on this for a long time. And Stanley Druckenmiller he's argued the same thing. If QE is successful, it's a reinflation or reflating of the economy. And therefore the yield curve should steepen and actually is bond negative. If QT is successful, therefore you should be slowing down the economy, then yield curve should kind of flatten. And you could make the case that QT is actually good for the long bond because it slows the economy down. Now, the difference is the QE is a policy tool that they use to actually increase the economy and get it going. Whereas QT, they're not using it as a policy tool and they're just trying to whittle it off the balance sheet in a way that affects the market as little as possible. I hope that helps.
Yeah, perfect. All right, next one, Lena.
Next one here. Good day, huddlers. Not sure This is a question for the great show, but I still believe one of you will be able to help me out with this. Looking to buy Petrobras stock ticker PETR4 on the Brazilian Stock Exchange. My current broker, PI Financial, can't do it for me. Would you know who can hear for us in Canada? Thanks a lot.
Kev, does Interactive Brokers not?
Yeah, but
you
is
can
there
access
not? There's wait. He shouldn't be trading both Canadian and Americans. You can go trade what's called an ADR, and it's big and it's liquid is AF, and it's PBR in US.
Yeah.
It's as simple
Makes
as that.
complete sense, Kev. All right, Lena, where can people submit their questions?
So if you have any questions for Kevin or Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right, Kev, this is where you go.
Okay, I guess this is the part where I'm supposed to do the ending bit.
Amazing how you still need the script after 200 episodes.
I've lost my script, but you guys know the deal. Thank you very much for tuning in. Patrick, where can they find
You
you?
can find me on Twitter at Patrick Ceresna, and you can follow me at bigpicturetrading.com. And Kev, where can they find you, buddy?
You can go check me out at themacrotourist.com. And listen, we can never have too many friends. Bull market, bear market, we're just happy for you guys to spend some time with us. Now stick around for the after show. Okay, so you got to give this beer a try, and you got to bring me one of these.
I will for sure.
Because it sounds like my kind of beer. Like I just even the description.
It's a blonde ale.
Like,
it's 4.5%.
Oh, see, it's a lightweight like me.
Yeah, it's a lightweight. But I just love the name, a mean sardine. It's like.
It is a good name. I completely
for
agree.
the Portuguese, it's a solid name. No, but it's
yeah.
and also
do they have a lot of sardines? Is that one of their fish?
Yeah, absolutely. That's the sardines.
Like a whole month of festivals.
Yeah, absolutely.
Oh, I didn't realize that.
And Iracema is a beautiful part of Portugal, and the sunsets there on the Atlantic, just absolute beautiful view. It's so a great name for a beer. It drinks nice and light. For
what number are you giving it?
I'm gonna give it a 7.9.
Oh,
I'm not gonna go
nice.
crazy high. It's definitely a great beer that and it's sessionable.
Oh God!
In a while since we've had some.
The word returns.
All right.
Okay. And speaking of sardines, like, have you gotten acquired a taste for them?
Absolutely, love sardines.
Oh yeah,
absolutely. But
really?
I barbecue them fresh as opposed to canned sardines. But I eat the canned ones too. But
so you get these fish. How big are they?
They're not big at all.
They're tiny.
No, not tiny, but
and like you just put them.
Yeah, you can easily eat 5 or 6 of them.
So you put them on the barbecue.
Absolutely.
You know what? Like, it sounds gross, to be honest. Okay, but Patrick is a really good barbecuer. Like, I know everyone thinks, like, every man thinks he's the greatest lover and the greatest barbecuer. Patrick is a great barbecuer, and you know,
because I drink beer while barbecuing. This is the key, right?
No, because you really did. You cooked that Wagyu steak and you made the chimichurri sauce, and it was a top 3 steak in my life.
Wow.
Oh yeah,
God.
it was a very
I'm
good
blushing.
steak.
It really was.
I'm blushing.
No, honestly, it was.
And the
it was
black
very
and
good
lobster
steak.
tail was fantastic.
Well, that was you fell down there, but that might have been me actually. I can't.
No,
remember.
that was me.
No, but
that was me.
Okay, but so I'm looking forward. I want to try one of your barbecued sardines.
Done.
Yeah,
Okay.
I think he's really good at barbecuing because if he can make squirrels taste good
I know.
with barbecuing, think about it.
I think he usually does those on a stick though. He has to improvise.
It's a different type of barbecue.
Oh my.
Yeah.
Not charcoal.
Yeah. Hey, so I finally went to the movie theater. I went to see Napoleon. I haven't.
You told us this. We talked about this
Yeah,
last
God.
it's already old
You know,
news.
that's
Okay,
my-
your part-timers is kicking in again.
Hold,
Tell me you're not.
hold on, we
old.
gotta get a sound effect for this. To no. Anyway, I did, by the way,
Yeah,
go to
no,
movies,
you-
and so that now that you guys know twice, did it?
Yeah, we're not going to talk about it.
Yeah,
Again.
so what did you-
Nina, what did you do?
Not much, but have you guys noticed that Netflix has have you seen that show Squid Game?
Yeah.
You know that there's an actual game show, like a reality game show that's I guess modeled after the TV show.
Is
and
it
there's
from
literally
Korea
real
or Japan?
No, it's all I think it's American based.
Oh, the
Most people are
Americans came up with
American. I don't know if it's like in partner with the creators of the show. I'm assuming it is. But there's real people. They go.
Seems kind of harsh though,
and
because you die
they're
if
paying.
you lose.
No, well, they don't kill you, but it's like you wear those little what are those? I don't know what they're called, but like, you know, when you get shot in the movies and then like a blood packet just kind of goes
like
off.
blood plaques or whatever.
Yeah. Like if they have it in their shirt.
Or do they use paint guns or whatever?
No, they have it in their shirt. So if they, you know, break the rule or they don't pass the game or whatever, they like something.
Like there's
goes
an
off on their
electronic one
shirt.
and someone presses the button.
Yeah. So as if they got shot and they get eliminated from the game.
Oh, that's pretty fun.
Pretty interesting. Yeah.
All right.
And then they're all, you know, competing against each other in all these like games, Korean games that kids play.
Oh, well, that makes sense because that was the same as Squid Games.
So I'm like yelling at the TV because I grew up playing these games when I was like 8. Yeah, and I was like, oh my gosh, they're doing it wrong.
Do they have any people from Korea playing?
Not that I'm aware of, no.
At least
not
from
that
the
I've
way
seen.
that they played the games. It
Yeah,
looks
like
they've never seen
or
them.
at least the people that they're highlighting are not of the Korean
Well,
descent.
I think we should all campaign to get you on the show, Lena.
Oh my God, Luke is like, oh, we can win like millions of dollars. We should get you to go on the show.
Hilarious.
Because you know what? No other Korean has thought that.
Exactly.
You'd be
right?
the first one.
This is the most original thought we've had in a long time.
Okay,
so that's what's been going on.
The market's still going, and I actually want to go back to trading. So thank you for tuning in. For everyone that's celebrating Christmas, have a great Christmas. Everyone else, have a happy holidays, and we'll see you on the other side.
See you on the other side. Thanks, everyone.
Take care. Bye-bye.